Hey everyone! Welcome to this in-depth analysis of the current economic situation, seen through the lens of Amazon, that giant which dominates 40% of online sales in the United States. Today, we're going to take a look at how, based on data from over 200 million Prime subscribers, we're starting to see warning signs of a potential economic crisis. What we're observing is that even a company as solid as Amazon is beginning to show signs of concern. Brian Olsavsky, their chief financial officer, said it clearly. People are tightening their belts, hunting for deals, and prioritizing the basics. And the numbers back it up. For instance, electronics, which made up 30% of sales in 2022, dropped to 21% in 2023, and all indicators show that decline is continuing in 2024. Furniture and home decor have also lost ground, going from 31% to 28%, while clothing, always a bit of a luxury, has been cut in half, from 48% down to 24%. In contrast, essentials like food and cleaning supplies have seen a modest 2.1% increase, showing that in times of uncertainty, consumers pull back from unnecessary spending and focus on survival. This consumer behavior is directly impacting Amazon's internal decisions. The company has started cutting back on projects and shutting down underperforming divisions. From eliminating their health tracking wearables, to discontinuing delivery robots, and even closing physical stores like Amazon Fresh and Amazon Go. Even their cloud business, which used to grow over 30% annually, is now only expanding by about 13%. These adjustments are clear signals. When the giant itself begins bracing for harder times, it's a strong indicator that the global economic outlook may be shifting dramatically. And it's not just Amazon. Traditional retailers like Target and Walmart are feeling the pressure too. Target saw a 3.7% drop in sales in 2023, and Walmart, even with its reputation as the king of low prices, only posted a 5.5% growth rate in 2024, the smallest increase in the past 4 years. This pattern reflects a consumer base that's growing cautious, spending only on necessities and avoiding extras. But the situation goes beyond what's happening at the checkout. The U.S. economy, which relies heavily on consumer spending, roughly 70% of GDP, is flashing other warning signs. Credit card debt has now surpassed $1.21 trillion, and with interest rates hovering around 22.75%, household financial burdens are becoming unsustainable. On top of that, consumer confidence indexes, both from the University of Michigan and the Conference Board, have fallen to levels historically associated with looming recessions. The housing sector isn't immune either. Mortgage applications have declined for 6 consecutive months, and in many cities, home prices are starting to drop. Sales of new homes have fallen significantly as well, signaling a notable cooling of real estate investment. And let's not forget, the government itself is tightening its belt. Budget cuts have begun to affect public sector jobs, with agencies like the Pentagon and the Department of Commerce reducing their workforces. This has a domino effect on local economies, hurting small businesses and service providers that rely on government employees. Given this landscape, those with the ability to adapt should start rethinking both their debt strategies and their investment portfolios. Consumers should consider paying down liabilities and increasing their emergency savings. Not just the traditional 3 to 6 months, but maybe 9 to 12 months instead. When it comes to investing, it's time to shift from high-growth stocks to more stable, protective assets like inflation-protected bonds, gold, or even essential sectors like energy, supermarkets, and basic services. The logic is simple. In uncertain times, safety takes precedence. In short, what we're seeing is a clear signal that the U.S. economy is bracing for rough waters. This isn't just a temporary scare. It's a real shift in consumer behavior that's rippling across sectors, from tech to real estate to fiscal management. While crises do present opportunities for those with liquidity to buy undervalued assets, for the majority of people, this is a moment to tighten up spending, reduce debt, and strengthen their financial cushion. As a liberal economist, I believe that market responsiveness and flexible resource allocation are critical for navigating periods of uncertainty. History shows us that economic crises, while painful, often create opportunities for renewal and structural growth. So this is a call not only for caution, but also for long-term thinking, to adapt, to innovate, and to seize the opportunities that emerge amid adversity. Thanks for joining me in this analysis. I hope these insights help you better understand the current economic landscape and make informed decisions to protect your future.